Greetings, members one and all of the Salivation Nation. Gold and silver continue to rise as the Federal Reserve contemplates utilizing a full range of tools to help the economy along. Let's explore. That's right, the Federal Reserve's everything bubble here, and that is what the this opinion piece here by the Hill.com. Before we get to that, let's take a look here. Gold futures have finished higher to recoup over half of their Monday losses. This article comes to us from MarketWatch. Gold futures finished higher Tuesday to recoup just over half of what they lost a day earlier, when positive results for an experimental COVID-19 vaccine fed a rally in the stock market. The Federal Reserve is far from done with pumping stimulus into the economy, and gold prices are liking it. And that is the full range of tools. It's very interesting. That is actually the terms used. We're going to talk about that later here. But this is from said Edward Moya, who's a senior market analyst at Oanda. And so gold had risen $11 to sell over $17.45 an ounce, and actually right now it's at $17.46.70. But here in this piece here from the Hill, it says that good economic policy making resembles good medical practice. In much the same way, a skilled doctor's effective prescription for a disease rests on an accurate diagnosis of an illness, so too a wise economic policymaker's effective crisis policy response depends on a comprehensive understanding of the crisis' underlying causes. One has to regret Federal Reserve Chairman Jerome Powell's seemingly partial diagnosis of our present daunting economic challenge, especially considering his key role in defusing the crisis. In Powell's view, our economic predicament has nothing to do with the possibility that years of ultra-easy U.S. monetary policy might have contributed to the creation of the worldwide asset and credit market bubbles. No, of course not. He dare not criticize his predecessors or the policies that have been done in the past. Rather, he seems to believe that our economic challenge is solely the result of the supply-side shock delivered to the economy by the coronavirus pandemic. And does it surprise you how short-sighted some of these people are in central banks and politicians as well? Following the bursting of the U.S. housing and credit market bubble in 2008, it took the U.S. economy some 6 years to regain its pre-crisis employment level. Dismissing any notion that the coronavirus pandemic might now be bursting asset and credit market bubbles of the Fed's creation, Powell believes that this time around we could have a quicker economic recovery than we did following the 2008-2009 Great Recession. And by the way, that's also an opinion held by our president. But, again, this doesn't talk about what they've been doing before this crisis became a big deal. The repurchase agreements where, a lot of billions and billions of dollars, $500 billion in one day. People forget that. That wasn't that long ago. That was right before all of this started happening. These repurchase agreements, known as repos, have been showing their rearing their horns out at us, and that's a sign of trouble right there. Then we had the inverted bond yield curves that had occurred as well, and that was kind of brushed off. But nonetheless, I think there were some signs of a recession before this started. This obviously has just hastened it all the more. Could there be a recovery quicker than what we saw in 2008, 2009? Possibly. We'll see what happens. But I'm not sure, especially with all the stimulus and all these tools that the Fed is talking about. But indeed, Powell believes the U.S. economy could fully recover by the end of 2021. notwithstanding the very much deeper economic recession that we are now experiencing than in 2008, 2009. Despite Mr. Powell's assertions to the contrary, over the past decade, the Fed, along with the world's other major central banks, created a global asset and credit market bubble. They did so by buying a staggering cumulative $10 trillion in low-risk government and private sector bonds, with the aim of forcing investors to take on more risk and to stretch for yield. The net result of that policy was the creation of a global equity and housing market boom, as well as a major distortion of world credit markets. One indication of the world equity price bubble was the very high valuation to which the U.S. equity market reached before its largely coronavirus-induced correction earlier this year. Measured by the cyclically adjusted price-earnings ratio before the pandemic's onset, U.S. equity valuations reached lofty levels experienced only 3 times in the past 100 years. Meanwhile, numerous housing markets around the world, including those in several large U.S. cities, had price-to-income ratios that exceeded those reached at the 2006 peak of earlier housing market bubble. More troubling yet, the world's major central banks have distorted global credit markets in a major way as investors were encouraged to take on excessive risk. One indication of such credit market excess was the more than doubling in the risky U.S. leveraged loan market to its present level of around $1.3 trillion. Other indications were the approximate doubling over the past decade of lending to the emerging market economies and the very low interest rates at which highly indebted countries like Italy were able to finance themselves. A key point to which Powell is choosing to turn a blind eye is the great likelihood that the very depth of the current economic recession, which is almost certain to be the worst experienced in the past 90 years, will burst asset price bubbles around the globe and make it more difficult for debtors to service their loans. And this is important, guys. We're kind of getting in the minutiae of the weeds of this, but this is about loans and debts accumulating around the whole world. This will be particularly the case for the travel, hospitality, and entertainment sectors of the world economy that are bound to be particularly hard hit, at least until COVID-19 vaccine is made widely available. If a wave of debt defaults and bankruptcies were to occur, we could see real stress in the world financial system. That is something that they're betting is not going to happen. But I tell you what, we are a debt-based economy around the whole world, it seems. Crazy. Save for a few nations and a few cultures, we feed off of debt, it seems. Another key point that Powell seems to overlook is the likelihood that the global economic recession could trigger for both another round of European sovereign debt crisis and yet one more major emerging market economic crisis. In this respect, it's hardly encouraging that the European economic recession shows every sign of being deeper than that in the U.S. and that Europe is still struggling to fashion a united fiscal response to the recession. Nor is it encouraging that capital is being withdrawn from the emerging market economies at a record pace and that a number of emerging market currencies already appear to be in free fall. To his credit, Powell responded both boldly and promptly to the initial phases of the current economic crisis. Hopefully, he stands ready to do more of the same at the first signs of real stress in the global financial systems. If not, we can be sure that a full economic recovery will be delayed until well after the end of 2021. Now, that is an interesting synopsis of what to do. This goes back to the tools. And I did a little bit of research. I didn't do that much of a deep dive, but I found some stories from major economic resources. And I'm not going to post them here to bore you with that, but it talks about this full range of tools. Well, what could these full range of tools be? You've already got the interest rates down right rock bottom at 0 to 0.25. The only way to go in here now is negative. And that way you're essentially leads to people being charged to save money. In other words, they want to get the currency flowing. They're already printing a whole bunch of money. It's being pumped into the markets. I believe that is really what is propping up the stock market. People having faith on that and putting some of their money in as well. But nonetheless, there's a lot of money being lent out, as this article talks about. And that is what's happening. So what more? There's only two things that can happen, no matter how many tools they have that the Fed can do. Number one, charge people to save money. That's negative interest rates. And number two, pump more money out, devalue the dollar, do whatever they can. They can use however many tools they want to do it, whether they lend at negative interest rates or they lend at low or no interest rates, or even just give money away. However they do it, money is going to flow somewhere. And by the way, when I mean money, I'm talking about currency, fiat designated. The dollar can only be showed as money for its fungibility and being backed by the U.S. government. In that way, you could, in a sense, call it loose money. And I tell you what, money is fast and loose these days with how much the Federal Reserve is printing. This man right here, Jerome Powell, is pumping it out like it's going out of style. And the summation of this article is that he should do more of the same. But you know what? I tell you what, how long will that last? How long can we keep doing this? There are other nations doing this too. And I feel that the good central banker here, Mr. Jerome Powell, our chairman, is betting on the other currencies doing it. And we can do it too because they're doing it. And we're the top dog in the block. And we can continue to do it for as long as we want to, at least for now. Well, it can only go on this way for so long before things change. Because right now, we're seeing people make a move. All this green right here is an increase in precious metal prices all across the board, from rhodium all the way down to silver. And in fact, silver is performing very strong right now compared to gold, starting to catch up. And we're now down to just above 100 to 1 in the gold to silver ratio based off the spot price in US dollar. So we're seeing somewhat of a tightening there. But the other thing to consider is that gold is holding its own. It's going up and it's high. And my feeling is that these metals will continue to climb. And I believe that gold will continue to shine because gold has been proven itself throughout history to be the ultimate form of wealth and prestige and as a wealth preservation vehicle. Silver has proven itself as money for thousands of years, and I believe in the long run it will prove itself to be, although it is more volatile, it is seen as a commodity, more so as an industrial commodity than as dormant money, like I refer to it as. But I think that its price action right now is reacting to what's going on in the news lately, especially when the Federal Reserve Chairman goes out and laments the economy and what they can do to fix it. But I tell you what, the Federal Reserve, as powerful as it may be, it's not the be-all end-all. And you know what is the be-all end-all to economic recovery? It's you and I in the free market system. And by the way, the best way to protect ourselves in any kind of economic instability is gold and silver. And when we see these prices move up, this should give us confidence in both these metals. And we're seeing a strong movement upward, and platinum is making some headway too, by the way. It's actually, aside from rhodium, which moved up 6.25% and is the biggest mover of all the metals here. I've always thought platinum was undervalued. I know there's a few others out here in the community that agree with me on that. And I've made some movements into platinum as a speculative play. Platinum is not, it's what I refer to as a fringe precious metal. It's very rare, but it has mostly industrial applications and uses. But I can't help but wonder if the movements we're seeing here in the last couple of days are because of it as a safe haven and acting in some ways like gold and silver. We'll see how it all plays out. But it is interesting indeed to see as the Fed contemplates a vast array of tools that they're going to use. Post your thoughts below. We'd like to extend a multitude of gratitude to you all for taking the time to watch, and encourage you to please rate, share, comment, and subscribe.